Confused about mortgages and where to start? Well, if you can give me 5 minutes, I'm going to break down a conventional loan and give you all the details you need to know. Let's start with the absolute basics. What is a conventional loan? Well, the first thing I can tell you about a conventional loan is it's the number one and most popular loan program in the United States. It's the most common, and most people who get mortgages, unless they're first-time homebuyers, have a conventional loan or a VA loan. Unlike government-backed loans, like FHA, VA, and USDA, conventional loans are privately funded by banks and credit unions and lenders around the country. Now, since this isn't a government-backed loan and it's more of a private loan, there are regulators who monitor this, and we're going to jump into them too. They're called Fannie Mae and Freddie Mac. If you've ever heard someone say Fannie Mae or Freddie Mac, they dictate the guidelines for conventional loans around the United States. If you're thinking about buying a house and considering a conventional loan, here are a couple high-level requirements that you're going to need to meet in order for this to happen. First off, let's address the big one, your credit. To qualify for a conventional loan with the most up-to-date guidelines as of November 6, 2024, you have to have at least a 620 middle score. Now, we don't go off the highest or the lowest, we go off the middle for a certain reason, and if you have a 621, a 620, and a 619, you would be right at the 620 mark using that middle score, and you would qualify for a conventional loan based on your credit score. Of course, as you would imagine, the higher your credit score, the better your interest rate. So a 620 credit score is going to yield a much different interest rate than someone with a 760 credit score, for example. So the higher the better in this scenario, as with most things. Once we tackle the credit piece, the next big question is how much money do I need to put down? And we're going to dive into this a little bit more as we get further into the video, but first-time homebuyers can put 3% down. Most people try and put 20% down though, because they get to avoid PMI or private mortgage insurance. However, the stigma out there is it requires 20% to buy a home, and it's just simply not the case. 3% minimum for first-time homebuyers on a conventional loan. Finally, and the last point I'm going to touch on to keep this video under 5 minutes is DTI, which stands for debt to income. That's essentially taking your income compared to your current debts, and your proposed housing has to be, in most cases, under 45%. But if you have a strong profile and maybe you have some reserves, you actually could go all the way up to 50 if the lender that you're working with allows it. I very briefly touched on PMI or private mortgage insurance, and this comes up when you put less than 20% down. So you put down 19.99%, you're going to have private mortgage insurance, which that'll never happen, but you would if it's less than 20%. Private mortgage insurance is essentially a fee that you pay monthly into your mortgage payment that protects the lender who gave you the money. It's literally in the name, private mortgage insurance. It's protecting them in the private sector who lent you the money for your home. The one big plus though is private mortgage insurance isn't on your loan forever. Once you drop below 80% loan to value, or you've made enough payments to where your loan compared to the value of the property is under 80%, would have been the same as you putting 20% down, and the lender will actually drop your mortgage insurance off of your loan without the need to refinance. Now, conventional loans as a whole, they come in two different main channels, and you can get a fixed interest rate or you could get an adjustable interest rate. They aren't very common in this high interest rate environment. For an adjustable rate, I actually haven't seen many adjustable rates since I've been in the industry for 12 years, but there is an option out there if you do want to gamble with an adjustable rate mortgage. To touch on that real quick, a fixed rate is exactly as it sounds. You lock in your interest rate at X%. It's fixed for the loan term. So if you have a 30-year loan and you locked in at, I don't know, 6%, your interest rate will be 6%, no changing it for 30 years. An adjustable rate typically starts lower than a fixed rate in some cases, and will be locked for a certain period of time based on the adjustable rate mortgage term you select. Here's a quick example. If you select a 3-1 ARM, it means that the interest rate you select up front is locked for 3 years. That's the first part of the 3-1. And then the 1 on the back end of that number actually insinuates that your interest rate can adjust once per year. So while adjustable rate mortgages could potentially be cheaper up front, they are a bigger gamble and there is more risk long term. So why would you take a conventional loan over an FHA loan or a USDA loan or even VA if you qualify for it? Well, there are a few different benefits. People typically choose conventional loans for the flexibility and the ease. With a conventional loan, you can buy a primary home, a second home, or an investment property. With loans like USDA, FHA, and VA, They cannot be used for second homes and they cannot be used for investment properties. So you have to default back to conventional in order to qualify if you're looking to obtain rental properties. Another benefit, as I mentioned earlier, with a conventional loan, once you get to a total of 20% equity in your home or below 80% loan to value, your private mortgage insurance drops. With loans like FHA, the government backed mortgage insurance is on that loan for the life of the loan. Here are a few potential drawbacks of a conventional loan. There are some downsides to consider if you're looking to buy your first home, and conventional may or may not be a good fit for you, and here's why. Conventional loans just have more strict credit requirements. If you're below a 620, your only options would be a VA loan if you served in our armed forces and you qualify, or an FHA loan, which will allow all the way down to a 500 credit score. So if you have a sub 620, a conventional loan is not an option for you, and you need something with a little more flexibility, which would be an FHA loan. The other major drawback is if you're not interested in paying private mortgage insurance, the only way you can get around that is by putting 20% down. So in order to not have an extra monthly fee added into your mortgage, you would need to have a fairly sizable chunk of money to put down up front as your down payment. Now, let's clear up a couple of misconceptions about conventional loans. That the stigma out there, like I mentioned, with down payment is a big deal for a lot of people. As I mentioned, you only need 3% to put down if you're a first-time home buyer. But let's say you're not a first-time home buyer and you're getting ready to go buy your next home, and you want to use the equity from your current home to pay off some debts and put minimum down on your next home. If you've had ownership in any form of real estate in the last 3 years, you are not a first-time home buyer, so you would be required to put 5% down minimum, which is not huge, and it's not 20% like a lot of people think. The other misconception, we just touched on it, is that in order to do a conventional loan, you have to have perfect credit. You just need to have above a 620, but as always, the higher the better with credit for better interest rates. That right there is a very quick high-level overview of a conventional loan. Now, I wanted to keep this under 5 minutes. I think I'm a few seconds over. However, I am going to be posting multiple conventional loan videos coming up into a specific conventional loan playlist that's going to document everything about this loan that you need to know. We're going to get very detailed on breaking down credit and income and the appraisal and frequently asked questions. I have about 35 videos coming specific to just conventional. So if you're in the market, if you're in real estate, or you're just wanting to learn more, make sure you subscribe to my channel, follow the playlist. We're going to be uploading multiple videos by the end of 2024 to get ready for a big year in 2025.